How's the business performed and how are your returns relative to the market?
The business has performed very well this year. We've seen the valuation of the portfolio up by almost 19% and NAV up over the year by almost 28%. And within that, there have been some exceptional performances. If you look at the development business, that again has delivered some exceptional results, up 31% over the 12 months. But rents have been rising as well, and they've been rising faster than the market. So our average rental growth over the year was something like 8.2%, and the market is around about 6%. So again, this business is producing better returns than its comparators in the market. And actually, this year we soundly beat every single one of our main comparator benchmarks.
And Nick, how do you view the financial performance and how does it compare to this time last year?
Yeah, I mean, I'd say these are very strong financial results, actually stronger, even stronger than those we issued this time last year. And I think the results again tell you the business is in great shape. We've outperformed market expectations. As Toby mentioned, our key financial metric, NAV per share, is up more than 27%, in fact up more than 8% in the final quarter. Earnings are up more than 70%, which means we've continued to grow the dividend. And I think crucially, as we look forward, given the depth of the development programme and a balance sheet which is as strong as ever, we have the capacity to deliver lots more organic growth.
Toby, we're seeing a rising property market and big demand from overseas buyers. How do you view that?
Well, we look at the market in three phases principally, and Nick has just referred to organic growth, and I think that's the core phase for us. So it starts with acquisitions. You then go through this execution phase where you are delivering all the business plans you've bought into before you then enter what we call de-risking phase. Today we are, in our minds, unquestionably in the execution phase, driving development returns, executing business plans that we bought into at a time when prices were lower. So if you go back to 2009, 10, 11, for example, we began buying. As at today, we have acquired something around 55% of every asset we own during that period of opportune pricing. Those buildings are now in our execution model where we're delivering new developments and executing business plans, generating this organic growth. And we're doing that rather than buying in today's market because we can make better returns on capital by investing in our existing portfolio than we can by buying in the market. So the way we see the market today is it's very competitive, lots of liquidity. A lot of that liquidity is overseas capital, which is quite helpful for us when we are beginning then to trade out of these business plans that we have taken as far as we think we can, selling to overseas investors in some instances, domestic investors in others. But it's quite helpful to have that liquidity behind us. The next few years, I think, are going to be all about growth from within the portfolio, be it driving rents, generating development surpluses. And I think the market's set pretty fair for that. I think the rental story is looking very interesting in central London, and I can expect a good degree of growth.
Well, a little more on that. Where do you see rental values going? Will West End rents continue to rise? Some see city office rents basically turning around 2017.
I think it's too early to forecast when we can expect to see the next peak in the rental cycle. I think it's a way off, mind you, because when we look at the supply side in London, there isn't a huge amount coming on stream, certainly not in the core markets around the core of the city and the core of the West End and Midtown, for example. There is quite a lot around the fringes and out to places like Stratford, for example, where there's a fair degree of development proposed, but they're very different markets to the core West End that we operate in, where 80% of our business is. So in those core areas, we think there is circa 3 million square feet of speculative space, which in the context of a market of a couple of 100 million square feet is not very much. And at the same time, we think businesses are beginning to build up inventory again. They're back on the recruitment phase, companies are looking to growth, and as a result, we think there is going to be more demand from businesses looking for space than supply, so we can expect rents to rise in the near to medium term. Whether it peaks in 17, 18, 19, 16, I couldn't tell you, but I don't think it's tomorrow, and I think we have a good number of years yet during which we can deliver good quality space that we are confident we can let to the sorts of businesses that we like to let to.
Yeah, so they're pretty interesting times. I mean, where do you think we are in the property cycle, notwithstanding the debate around interest rates?
As I say, I think it's too early to call the rental cycle. Clearly, investment pricing has been growing quite strongly as liquidity from around the world has been looking for yield and has been looking at London as a relative safe investment location. Can we expect to see prices rising at the same rate that they have been whilst those yields have been coming in aggressively? That's a very good question. I think it's going to depend largely on what happens to rents, and buildings that can access good rental growth, I think we'll see some attractive total returns in the next few years, and that will play to the strength of businesses like ours, where we can develop fairly substantial amounts in the core markets into this supply shortage. So if you can get rental growth, I think the prospects for the next few years are very interesting indeed. If you are reliant on off very low yields, having bought off low yields buildings that are not going to be able to generate significant amounts of rental growth, I think your returns may be a little thinner, but that's not our game.
Nick, a good question. What's your view? What's your perspective?
Well, I think it's very difficult. If you look back over the course 6 months ago, people were saying rates are rapidly moving up. And if you look back on a 24-month horizon, you have seen gilt rates nearly double. You have seen 5-year swap rates more than double. But over the course of the last few weeks, you've seen the return of talk of lower for longer. I think any business prudently needs to be looking ahead to the risk that in the medium term, interest rates will move up. And so, for example, one of the things that we have done is through 1.2 billion of debt refinancings over the course of the last 2 to 3 years. We've increased our interest rate protection through 98% of our debt book today, either being at fixed or hedged rates.
Can you talk a little bit more about the performance of the development business?
It's been a very strong year. We've seen a year in which we finished 3 buildings. They generated a return on cost well above normal underwriting levels this year, circa 50%, 52%. We have another 2 buildings on site at the moment, which we are expecting to deliver a return on cost of circa 40%. So again, above normal underwriting levels. And that's because we're letting them quicker than the underwriting assumptions for the reasons I was describing earlier. And I think that there is more to come on those returns as these rents rise in the next few periods, which I think is very encouraging. Beyond that, we have a further 7 schemes in our near-term pipeline of something around 800,000 square feet in total. And that the largest scheme within that group is our Rathbone Square proposals, where we are due to begin residential sales later this year, which is a very exciting project. And if you add it all up, we have a pipeline of circa 2.2 million square feet, which covers about half of the group's assets, and over the long term has the potential to add significant value to the group. Now, clearly, some of the dates are probably into the next cycle, but I think one of the things this business does very well is build up the future potential through its pipeline, so that we're planning today for returns 10 plus years hence in some instances, which I think adds a depth of interest for the group.
And Nick, can you put some numbers on the development performance in the year?
Yeah, and I think as Toby mentioned, we finished 3 schemes in the year. They delivered a profit on cost of 52-53%. And actually so far this cycle, we've completed 8 schemes, on average delivering a profit on cost of 49% at the point of completion. But interestingly, if you look at their values today, they've generated a profit on cost of 69%. So you've seen some good post-completion performance as we've captured the further rental growth that's been delivered on those assets over the course of the last year or so.
You've talked a bit about how you're going to extend the development portfolio. Can you talk a little bit more about that? I mean, are you doing enough?
Good question. Are we doing enough? I think you have to balance the risks inherent within speculative development with opportunities for return on capital elsewhere in the portfolio. What I think is particularly attractive about where we are today is that we don't have to go out and buy anything else. We have a hopper, if you like, which is jammed full of opportunities to create growth in the long term. And some of the schemes that we're working on today are buildings that we've owned for a while. We now have vacant possession, or we have vacant possession around the corner, and we can begin to reinvigorate that building to create something rather more special than that exists today. So we have this portfolio with 2.2 million feet of potential in it. I think the markets will look to the next few years to see how much surplus we can generate during that relatively shorter period. We have to be looking at that and the longer term, and for the longer term I think we have a really exciting few prospects as well.
So Nick, from your perspective, I mean, how much are you going to spend on your development portfolio going forward?
Well, at the moment we have 2 schemes on site. CapEx still to come is around £50 million. As Toby mentioned, they're expected to be highly profitable, just over 40% profit on cost, and already 69% of the income has been secured through pre-lets. If we then look to the 7 near-term schemes, collectively the CapEx there will be circa £375 million, and we think that this committed and near-term schemes will deliver very attractive returns for shareholders, particularly when you bear in mind that 75% of the CapEx to come on these schemes is associated with developments at the regenerating east end of Oxford Street, and in fact 100% of the CapEx is associated with schemes which are within a stone's throw of Crossrail, so we think there's plenty more performance to come. And crucially, we have the financial resources and the balance sheet capacity to deliver these schemes without taking undue market risk.
So you're saying you're happy with your balance sheet and the balance sheet strength at the moment, because you are in a high CapEx phase, aren't you?
Yeah, and I think if you go back to where Toby started out, we are seeing a market where there is attractive rental growth, but we have yields at relatively low levels. So it feels to us the right position to have is one of relatively high operational gearing and relatively low financial gearing, and that's absolutely what we have. LTV today is around 25%. Interest cover is up at north of 4 times. We continue to have one of the lowest cost debt books in the sector. Our weighted average interest rate is only 3.5%, and we have more than 500 million of cash and committed firepower that we can access. And don't forget, we've proven time and again that our access to incremental funding is there. We went to the market last summer to issue a convertible bond. We raised £150 million and we paid a coupon of 1%. That's a record low for a sterling convertible. So we have the access to further funding if we need it.
Toby, you've been a net seller of assets in the year. Are you calling the market?
No, we said this time last year that we would likely sell more than we bought for some of the reasons I described earlier, being the attractiveness of returns inside the portfolio rather than outside the portfolio. If you think about the business model, what we have always sought to achieve is execute a game plan in any given asset, and then when the forward IRR is not at a level which we feel is high enough, somebody with a lower cost of capital than us is likely a happy holder of that asset, sell it on to them, and re-employ that cash, that capital, into new opportunities within the group elsewhere. That model stands today, so the sales you are seeing us making this year and probably next are really the continuation of that game plan, where we're crystallizing returns from our efforts and putting that cash back into new opportunities in some of the schemes that Nick has just talked about. So it's not a market call as such. Clearly, if we felt that there was another X% growth in valuation to come from an asset, why would we sell today? So we're calling the specifics on an asset, but not necessarily on the market. And for the reasons I described earlier, the right buildings, we think there's still good growth to come.
Crystallising the assets. So can you just run through the disposal and the proceeds you made in?
Yeah, so we made 4 sales through the course of the last financial year. Collectively, they generated proceeds of just under 270 million, our share of the proceeds. Crucially, selling ahead of book value, on average a 9.5% premium to book value, and typically selling assets off relatively low yields. The average net initial yield was around 2.3%. As Toby said, each of the sales had its own drivers. 2 of the sales were actually potential near-term development assets where, based on the sales price that we achieved, we're able to crystallise all of the development return without taking the risk. So we're a very happy seller of those assets where we can use the capital more accretively elsewhere in the portfolio. The 3rd sale was a city office building. It was actually the first purchase that we made following the 2009 rights issue. We bought it when the market was on its knees. We bought it off a yield in the 8s. We went in, we re-geared and restructured the leases. We sold it off a yield in the 5s, crystallising an ungeared IRR of 13% on a relatively low-risk asset. So for us, that felt like a very sensible trade. The final deal in the year was we created a new joint venture with our holdings at Hanover Square. Very exciting development scheme. So why did we JV it? Principally because we wanted to crystallise some of the returns we generated to date through the site assembly, through the planning consent that we'd achieved, and as a reasonably large scheme, sharing the risk with a high-quality, high-calibre partner of the likes of the Hong Kong Monetary Authority. Felt like a very sensible transaction for us to be undertaking from a risk-reward perspective.
So Toby, you're going to remain a net seller of assets?
I think this year we probably will be, but again that's a consequence of where we are in the asset strategies of various things we own. So if you think about Rathbone Square for a second, there we have circa 140 private units, residential units, that we will be looking to sell later on this year. And you can imagine, therefore, given it's right next to Crossrail, just off Oxford Street at the eastern end, you can imagine that we will achieve some attractive pricing there. So I think if you add up the various stages of business plans we're at for some of our development stock, you can imagine that we are likely to be a net seller. On the other hand, if we find some fabulous value in the market where the returns to be accessed are higher than from our existing stock within the group, we might buy it. But as it stands at the moment, I expect we will be a net seller again this year.
So Nick, still acquisitive. Do you still think there's value to be had in this market?
We're going to be very, very selective with regards to our acquisition activity. Clearly, there is not deep value in the market as we saw back in 09 and 10, but we're always on the lookout for new opportunities. And if you look back over the last 12 months, we made one purchase, an off-market transaction, £90 million we paid for Oxford House at the regenerating east end of Oxford Street, and it had all the hallmarks of the kind of kit that we like to buy. Good location, in fact an improving location, directly opposite a Crossrail station, and really importantly, the building's let off low rents and there's lots of angles for us to exploit. And if you put that together with our other assets at the east end of Oxford Street, we now have around 700,000 square foot of development potential in what we think is perhaps the best regeneration story in central London. So we will be selective.
So Toby, when do you think the disposal and de-risking of the business will start in earnest?
I don't have to answer that question yet because I think it's too early to call that judgment. I don't think you need to make that call today. I think I would however say that this is a business that is in an expansive frame of mind. We're clearly growing our developments and creating some significant value through that process. But we're doing so from quite a low risk standpoint. So Nick's touched on gearing already. With an LTV in the mid-20s, you can see that we have significant capacity there to grow. And I think that's a great balance. It's something we've done consistently through the last cycle. Match high operational gearing, lots going on in the portfolio, with low financial risk. And that mix is a powerful mix, I think, and one that we will continue over the next few years.
How do you view the performance of your leasing activities in the year?
Well, we had a record leasing year last year, marginally beating the previous record of 2012, so that was a very strong performance from the team. 84 deals, mid-20s millions of rent, which for us is a big number. And I think the really satisfying piece in the story of leasing last year was the quantity of pre-lettings that we continue to do. And what that tells you is that the buildings we have been developing, like 240 Blackfriars Road, for example, like Wigmore Street, are in the right locations, and the quality of the product is exactly right for that micro location. So we're finding businesses that want to come to our buildings in those locations. And I think that's likely to continue. I think as we look at the next phase of development stock that we expect to deliver in the next few years, I can imagine that we will see pre-letting continue. And what's interesting is if you go back a generation, you would never have seen the quantity of pre-lets 10, 15, 20 years ago in the West End that you are seeing in good quality buildings today, which harks right back to what I was saying at the beginning, where there's not a lot of supply, and if you can bring on stream good quality buildings, there is demand out there, and you should be able to pre-let some of it.
And Nick, can you run through some of the stats and the successes within the leasing business?
We had a record leasing year last year, 25.9 million of new rents secured, and we've had a great start to this year. We've already secured more than 3 million through new deals. We've got more than 3 million under offer, and there's lots to play for. You know, remember our average office rent, despite the fact that everything we own is within central London and the vast majority in the West End, average office rent's still £42 a square foot. Reversionary potential within the investment portfolio north of 22%. There's lots for us to play for even before you then overlay the development programme. And I ran through earlier the capex to come on our committed and near-term schemes. You know, those schemes we think will collectively deliver an extra 50 million of rent roll. You know, in the context of our current rent roll, that's a 53% increase from where we are today. So there's lots and lots potentially to come from continued successful asset management and leasing.
So Toby, what's the outlook, and can you maintain the momentum in the business? With something that the relative performance might tail off.
We can't judge what the market will deliver, but what we can judge is the positioning of the assets that we have and the way that we're going to exploit their potential. And I think on that count, the next few years looks very interesting. And if we just consider some of the developments we have, they are in some of the most interesting locations in London, be it Rathbone Square at the east end of Oxford Street, be it some of our projects in and around Oxford Circus. We're launching Wilmar House just 50 yards north of the Circus later this summer, and there is a classic stock-in-trade GPE product, 60,000 square feet, with rents in the core of London, office rents that are in the 60s and 70s pounds a square foot. That is not particularly demanding, but off that level we make a decent return. And if you add all of those sorts of projects together, I think the next few years for this group are very exciting, whatever the market delivers. Do we expect to continue to beat the market? Generally, answer yes. Reason, because of what we own and where we own it, and the low starting point, as Nick has just described, of our average rents being still very attractive. The other thing I would say is we have circa 20% of the group in retail, and most, if not all of that retail is on the core streets of Oxford Street, Bond Street, Regent Street, and some on Piccadilly, Jermyn Street. Now those are streets which in many ways, more than the office markets, are starved of new product, and yet there is an enormous amount of demand looking for units in these streets, and our average rents in these retail units is also very low, so I can imagine that we can expect to see some significant retail growth coming through in the next few years. Last year was 12% against a market of circa 7 annual ERV growth percent, and I can imagine that we will see that sort of a beat over the next few years as well.